Imagine this. It's the first of the month. You wake up, you grab your phone, and before your feet even hit the floor, $3,000 deposited. You didn't clock in, you didn't sell anything, you didn't chase clients. Companies you own sent you their profits while you slept. That's not hype, that's equity. And this is the blueprint. Let's define the objective clearly. Not extra income, not beer money, not maybe one day. $3,000 per month, $36,000 per year, every year, paid by assets. Now pause for a second. What would $3,000 per month change in your life? Would it eliminate your rent? Would it remove your car payment? Would it let you say no to a toxic job? Would it give you margin instead of anxiety? This isn't about becoming rich overnight. This is about financial sovereignty. The ability to cover your core living expenses without selling your time. That's a completely different level of security. Here's what most people misunderstand. They think passive income is about escaping work. It's not. It's about removing desperation. When your essentials are covered by dividends, your decisions improve. You negotiate differently. You invest differently. You take calculated risks instead of fearful ones. And here's the shift that changes everything. The gap between $0 and $3,000 per month is not random. It is structured, it is mathematical, it is built through capital deployment. Ownership creates leverage, leverage creates income, income creates optionality, and optionality is freedom. So the objective isn't money, the objective is control. And once you understand that, the entire strategy becomes clearer. Now let's get surgical, because clarity kills doubt. If your goal is $36,000 per year in dividend income, the only question is, what yield are you comfortable with? At 4%, you need $900,000 invested. At 6%, you need $600,000. At 8%, you need $450,000. 3 paths, 3 risk profiles, 3 speeds. The 4% path is conservative, blue chip dividend aristocrats. Lower volatility, slower climb. The 6% path is balanced, a mix of dividend growers and higher yield assets. This is where many serious investors land. The 8% path is aggressive, heavier exposure to rates, preferred shares, business development companies, higher income, more price swings. Now here's the mindset shift. Most people see $600,000 and shut down, but that's because they think in totals. We think in units. At a 6% yield, every $10,000 invested $600 per year. That's $50 per month. So let's break it down. 10 blocks of $10,000, $500 per month. 20 blocks, $1,000 per month. 60 blocks? Now we need to talk about something uncomfortable. Speed. Because wealth is not just about direction, it's about velocity. Let's compare 2 people. Person A earns $40,000 per year. They save 30%, that's $12,000 invested annually. Person B earns $100,000 per year. They also save 30%, that's $30,000 invested annually. Same discipline, same percentage, same mindset, but wildly different timelines. Person A, over 30 years to reach their target. Person B, roughly 15 years, half the time. Same savings rate, double the speed. This is the velocity problem. Most people obsess over yield. They obsess over which stock pays 7% instead of 6%. But the real lever isn't yield, it's income power. Your earning power is the engine. Dividends are the fuel. And if your engine is small, no amount of fuel fixes that. Here's what most people get wrong. They try to optimize the investment strategy before optimizing their earning strategy. That's backwards. Because increasing your income by $20,000 per year is mathematically equivalent to having hundreds of thousands more invested. Income growth compresses time, and time is the most valuable variable in compounding. Now, here's the psychological trap. We focus on investing because it feels passive. Learning a new skill feels hard. Negotiating a raise feels uncomfortable. Switching industries feels risky, but staying stuck is riskier because low velocity means long exposure to inflation, market cycles, and life surprises. Wealth is not built on savings alone. It is built on 3 streams: savings, dividends, income accelerators. If you increase your engine size, the dividend machine reaches cruising speed much faster. And once it's moving fast enough, momentum does the heavy lifting. The question isn't just how much am I saving? It's how fast am I increasing my capacity to save? Because speed changes everything. This is the part most dividend investors don't want to hear. Before you obsess over stocks, you need to obsess over skills. Phase 1 is not about picking the perfect dividend ETF. It's about increasing your income power. Because here's the uncomfortable truth. If you're earning $45,000 per year and barely covering expenses, even aggressive investing won't get you to $600,000 anytime soon. You don't have an investing problem. You have an earning capacity problem. And the fastest way to accelerate your dividend timeline is not finding an 8% yield. It's raising your income by 20%, 30%, even 50%. Let's make this concrete. If you increase your income by $20,000 per year and invest that entire raise, that's $20,000 additional capital annually. At a 6% yield, that's $1,200 per year in future dividend income for every single year you sustain that increase. And here's the wild part. That $20,000 raise is financially equivalent to already having roughly $300,000 invested at 6%. One career shift, one skill stack, one promotion equals years of compounding. So what does a skill sprint look like? It's 12 to 24 months of focused intensity. You learn high-income leverage skills, sales, coding, AI tools, project management, specialized trades. Anything that increases market value. You treat it like a temporary campaign, because once your income jumps, your investing capacity jumps, and investing capacity is what fuels the dividend machine. Now here's the psychology behind this. Investing feels comfortable. Skill upgrading feels uncomfortable. One requires clicking a button, the other requires growth. But growth compresses time. And time compression is the difference between financial freedom at 40 or financial freedom at 65. You are not trying to grind forever. You are trying to sprint strategically, build the engine, make it powerful, then let the dividend fuel compound inside it. Because once your earning power increases, everything else becomes easier, and easier is faster. Now we move into something most investors never even consider: acceleration. See, saving from your paycheck is good, but saving alone is slow. Let's say you're investing $1,500 per month from your job. That's $18,000 per year. Respectable, disciplined, but steady. Now imagine you create one additional income stream, just one. Maybe it's freelance work, maybe it's consulting, maybe it's flipping digital assets, maybe it's renting unused space. It brings in $500 per month. That's $6,000 per year. And here's the key, that $6,000 is not lifestyle money. It is ring-fenced. It has one job: to accelerate capital formation. Now your annual investing power jumps from $18,000 to $24,000. That's a 33% increase in velocity. Same job, same life, just one additional lever. And here's what most people don't realize. Acceleration early in the compounding curve has exponential effects later. Because compounding is front-loaded sensitive, the more capital you inject early, the more years that capital compounds. That extra $6,000 per year, invested consistently for 10 years at 7%, that alone grows to nearly $83,000. And that $83,000 at a 6% yield? That's nearly $5,000 per year in passive income from just the accelerator stream. This is how timelines shrink. Now here's the emotional shift. Most people treat side income as spending fuel. They upgrade their lifestyle. Better car, better apartment, more subscriptions. The wealthy treat side income as freedom fuel, temporary intensity, permanent optionality. And here's the most powerful part. Once your dividend income hits $3,000 per month, you can shut the accelerator down. It was never meant to be forever. It was a strategic lever. You don't hustle endlessly. You accelerate deliberately, then you let the machine take over. This is the difference between drifting toward freedom and engineering it. Acceleration isn't about working more forever. It's about working smarter now, so you don't have to later. Now we build, not randomly, not emotionally, not based on YouTube comments. We build with structure, because here's what most beginner dividend investors do. They chase yield. They see 8%, 9%, 10%, and they jump, or they go the opposite direction. They play it so safe their portfolio barely beats inflation. Both extremes slow you down. So here's the framework, the 70-30 rule. 70% of your capital goes into foundation assets, dividend aristocrats, blue-chip global companies, businesses that have raised dividends for 20, 30, 40 years. These companies survived recessions. They survived crashes. They survived inflation cycles. Their yield may only be 2% to 4%, but they grow, they compound, they protect. This is the part of your portfolio that lets you sleep. Now the other 30%, this is your yield engine, REITs, business development companies, preferred shares, high-quality income-focused funds. These assets may yield 6% to 8%. They're more volatile, but they produce serious cash flow. Now let's run a simple example. You have $100,000 invested, $70,000 in dividend aristocrats at 3.5% yield. That's $2,250 per year. $30,000 in yield boosters at 7% yield. That's $2,100 per year. Total annual income, $4,550. Blended yield, 4.55%. Balanced, strategic, sustainable. Now scale that to $500,000. You're generating roughly $22,750 per year. You're closing in on your target. This is what architecture does. It gives you predictable income without reckless risk. Now here's what most people don't realize. Income without stability collapses. Stability without income stagnates. The 70-30 structure gives you both foundation and firepower, defense and acceleration. Because you're not building a portfolio to impress people. You're building a machine to replace income. And machines require design. This is design. Not gambling, not guessing, engineering. And once you understand that, you stop chasing headlines and start building systems. Now let's go deeper. Because most people think diversification means owning a lot of stocks. 20 positions, 30 positions, maybe even 50. That's not true diversification. That's just quantity. Real dividend diversification is about behavior. Different assets behave differently in different economic environments. And if you want your income to survive recessions, inflation spikes, rate hikes, and market crashes, you need multiple dividend engines working at once. Quadrant 1, dividend growth. These are companies that might only yield 2% today, but they increase their dividends 8%, 10%, sometimes 12% every single year. Over time, your yield on cost explodes. This is long-term compounding power. Quadrant 2, high yield, REITs, utilities, telecom, income-focused funds. They may not grow dividends fast, but they pay you now. Immediate cash flow. Quadrant 3, aristocrats. These are the anchors. Companies that have raised dividends for decades through wars, recessions, financial crises. They're not flashy. They're resilient. And resilience is income insurance. Quadrant 4, international exposure. Most investors are heavily concentrated in one country. But strong dividend payers exist in Canada, Europe, Australia, Asia. International exposure adds geographic diversification, and sometimes currency diversification. If the dollar weakens, foreign dividends can actually strengthen your income stream. Now here's what most people don't realize. When one quadrant struggles, another often compensates. In high inflation environments, certain sectors outperform. In recessions, defensive dividend aristocrats stabilize income. In global expansions, dividend growers accelerate. You're not just diversifying companies, you're diversifying income behavior. That's the difference between a portfolio that survives and a portfolio that thrives. Because the goal isn't just to collect dividends in good times, it's to keep collecting them in bad times. That's when the machine proves itself. Now this is where most dividend investors get it completely wrong. They see a stock yielding 9%, 10%, sometimes even 12%, and they think, I found it. But here's the uncomfortable truth. The market is not stupid. If one company is paying 10% while similar companies pay 3%, There is usually a reason, and often that reason is risk. Here's the trap. A high yield looks like instant income, but if that dividend gets cut, your income collapses. And worse, the stock price usually drops too. So now you lose income and capital. Double hit. Now let's compare two strategies. Investor A buys a stock yielding 8% today, but that dividend never grows. Investor B buys a stock yielding 2%, but it grows its dividend 10% per year. Year 1, Investor A earns $800 on $10,000. Investor B earns $200. Investor A feels smarter, but fast forward. After 10 years, that 2% dividend growing at 10% annually is now paying over $500 per year. After 15 years, over $800 per year. After 20 years, over $1,200 per year. And here's the kicker. Investor B's effective yield on original cost is now over 12%, even though the stock might only yield 3% to new buyers. This is where it gets really interesting. Dividend growth compounds just like capital. Small seeds become income monsters. Now, I'm not saying avoid high yield entirely. That's what the 30% allocation is for. But the core of your portfolio? It should be built on dividend growth durability. Because growth creates sustainability. Sustainability creates confidence. Confidence lets you stay invested during downturns. And staying invested is where real wealth forms. Here's what most people don't realize. The goal isn't the highest yield today. The goal is the highest reliable income 10 years from now. Chase yield, and you might win short term. Chase growth, and you win long term. And in dividend investing, long term is where freedom lives. Now let me show you the part that makes this whole blueprint unstoppable. Automation. Because here's the truth most people don't want to admit. The biggest threat to your dividend machine is you, emotion, hesitation, second guessing, timing the market, skipping contributions when life gets busy. All of that kills compounding. So we remove it. Here's the system. Paycheck hits, automatic transfer to brokerage, investments executed, dividends paid, dividends reinvested, shares increase, future dividends grow, and the cycle repeats. No decisions, no drama, no headlines influencing you, just math. Here's what most people don't realize. Compounding doesn't need genius. It needs consistency. Imagine investing $500 every 2 weeks automatically. That's $13,000 per year. At 7% annual returns over 15 years, that becomes roughly $325,000. And you didn't need perfect timing. You didn't need insider knowledge. You didn't need to watch markets daily. You just needed discipline turned into automation. Now here's the psychological advantage. When contributions are automatic, you don't feel the sacrifice. The money never sits in your checking account long enough to tempt you. It moves before emotion enters the equation. And when dividends are automatically reinvested, your portfolio grows without you lifting a finger. 1 share becomes 2, 2 become 4, 4 become 8. Silently. This is the flywheel effect. At first it's slow, you barely notice it. But once the portfolio crosses certain thresholds, the dividends themselves start doing meaningful work. They start covering bills, then expenses, then portions of your lifestyle. And here's the key. Automation protects you from yourself during downturns. When markets fall, the system keeps buying. When fear rises, the system keeps compounding. That's how wealth is built. Not through brilliance, through structure. Set the machine, lock it in, let it run. Because when compounding is on autopilot, time becomes your most loyal employee. Now we talk about something most dividend investors completely ignore. Taxes. Because you can build a beautiful dividend machine and then quietly lose 20% to 30% of it every single year without even realizing it. Let's say you reach your goal, $36,000 per year in dividends. If you're losing 25% to taxes, that's $9,000 gone. You're not making $3,000 per month anymore. You're making $2,250. That's the difference between covering your rent and almost covering it. Taxes are silent friction, and friction destroys compounding. So here's how smart investors defend. First, Roth IRA. This is a dividend investor's secret weapon. you contribute after-tax dollars. But once the money is inside, every dividend, every reinvestment, every dollar of growth, tax-free, forever. Imagine building a $500,000 dividend portfolio and never paying taxes on that income again. That's power. Second, traditional IRA or 401k. Here, dividends grow tax-deferred. You don't pay taxes each year. You only pay when you withdraw in retirement, potentially at a lower tax bracket. Third, taxable brokerage account. Now here's where placement matters. High-yield assets like REITs, better inside tax-advantaged accounts. Dividend growth stocks with qualified dividends, more efficient in taxable accounts. This is called asset location. Same investments, different tax treatment. Massive difference in long-term results. Here's what most people don't realize. A 2% to 3% drag from taxes over 20 years can reduce your final income by hundreds of thousands of dollars, not because you invested poorly, but because you structured poorly. Building wealth is only half the equation. Defending wealth is the other half. And once your dividend income starts replacing real expenses, defense becomes just as important as growth. You don't just want income, you want net income, because net income is freedom, and freedom deserves protection. Now let's step back, because this isn't random information. It's a sequence. First, you calculate your number. Maybe it's $450,000, maybe it's $600,000, maybe you take the conservative route, but now you know the target. Second, you increase your earning power. You don't wait passively, you compress time. Third, you accelerate capital with ring-fenced side income, temporary intensity, permanent optionality. Fourth, you construct with architecture, 70% foundation, 30% yield enhancement, balanced, durable, strategic. Fifth, you automate everything, no emotion, no hesitation, just compounding. Sixth, you defend with tax strategy, because keeping more is earning more. And when you layer all of this together, something powerful happens. You stop feeling dependent. At first, dividends cover a small bill, then your phone, then your groceries, then maybe your rent. And one day, you wake up and realize your lifestyle is funded by ownership, not effort, not stress. Ownership. Here's what most people never understand. Financial freedom isn't an event. It's a threshold, and that threshold is crossed gradually. Every $10,000 invested at 6% equals roughly $50 per month. Stack 10 of those blocks, $500. Stack 60. You've reached $3,000 per month. It doesn't feel dramatic while you're building it, but one day, it feels inevitable. And that's the real power. Not lottery wins, not overnight riches. Predictable systems, built intentionally. Freedom doesn't arrive because conditions are perfect. It arrives because you built for it. So here's your move tonight. Calculate your number. Open or fund your Roth. Set your first automatic contribution, even if it's $200, because momentum begins with action. If this blueprint changed how you see dividend investing, subscribe. Drop your target monthly dividend goal in the comments. $1,000, $3,000, $5,000. And remember, we don't chase money, we build machines that produce it. Your dividend machine doesn't start someday. It starts when you decide. I'll see you in the next one.